So, if you follow the junior mining space, you've probably seen this play out 100 times. Some company has what looks like a great project, but they just can't seem to raise the cash they need. It's this constant, endless struggle. What is really going on here?
And the first thing you'll almost always hear from a junior mining CEO is this little gem. They'll say it's bad market sentiment, or commodity prices are too low, or that investors are just, well, they're just not smart enough to get it. It's always someone else's fault.
Okay, but what if that's not the real story? What if the problem isn't that investors don't understand the story, but that they're finally starting to understand it a little too well? What if this whole capital crisis is actually a self-inflicted wound?
And that really gets us to the core of this whole thing. The idea that there's this big capital crisis is, well, it's mostly a myth. The real problem isn't the market. It's the fundamental business model that has taken over the junior mining industry. I mean, these excuses are probably super familiar to you, right? When the uranium juniors are struggling, oh, it's because investors just don't get the supply deficit. If it's gold, it's because the price hasn't popped yet. It's a really convenient story that always points the finger away from the companies themselves.
Look, the hard truth here is that the whole sector is suffering from this massive crisis of credibility. For decades, it's been a system that has rewarded just being busy over actually achieving anything. It's rewarded talking a big game over actually producing. The problem isn't a lack of money out there, it's a profound lack of trust.
And right at the heart of this credibility crisis is this character we really need to understand, the lifestyle company. And this isn't just a few bad apples. We're talking about a playbook that has become systemic. So what is a lifestyle company? Well, on the surface, it looks just like a real developer. But its actual purpose? It's just to keep the lights on, to keep those management salaries flowing. You see, building a mine is hard. It's risky. It requires real accountability. But running a lifestyle company? That's pretty comfortable. And the playbook they use? It's actually pretty simple. And sadly, it's really effective. Step 1, you grab a project that already has a bit of a story. Step 2, you just drill. Not to actually build a mine, but just to spit out news releases. Step 3, that news is then used to justify the next round of financing, which, you guessed it, funds more drilling and, of course, pays the salaries. It's a perfect little loop that produces fees, not ounces of gold. And this brings us to what might be the single most important question you as an investor can ask. If a company has been poking holes in the same deposit for 5, 7, even 10 years, and they already have enough resources to build a mine, why on earth are they still drilling? And the answer, far too often, is that drilling is just easier and more profitable for management than, the actual hard work of building something. And look, this isn't just some isolated problem with a few bad apples. The scale of this issue is, frankly, shocking, and it affects the entire sector. According to the data, fewer than 1% of all the junior miners listed on the TSX Venture Exchange ever actually make it to commercial production. Yeah, just let that sink in for a second. Less than 1%. This isn't just because mining is tough. It's because the system itself is actually set up to reward this kind of failure. So, if the success rate is that abysmally low, you have to ask, right? Where are the billions and billions of investor dollars actually going? If they're not being used to build mines, what are they building?
Well, this is where a lot of it goes. We're always told to look for experienced management. But in this sector, experience often just means a long history of raising a bunch of money and, well, failing to build a mine. The CEO on the left has experience. The developer on the right has a track record of actually building things. And tragically, the market often can't tell the difference between the two.
And honestly, this is the real tragedy of it all. For every, say, 50 of these lifestyle companies, there might be one legitimate developer out there really trying to do the right thing. But because investors have been burned over and over and over, that one good company just gets starved of capital. The bad actors poison the well for everybody. So, okay, is it all just hopeless? No, absolutely not. But it demands a complete shift in how we look at these companies. It requires a new framework, one built on credibility. It's a powerful tool that savvy investors can use to fight back. So we can start by, actually scoring management based on what they've delivered. Forget what they say they're going to do. Have they built a mine before? Boom. That's the ultimate metric. That's worth 10 points. Did they make money for their lost set of shareholders? Great. That shows they respect capital. But on the flip side, did they miss all their own deadlines? Or even worse, do they have a history of running these lifestyle companies? That's a huge red flag. All of a sudden, their promotional resume turns into a very objective report card.
And then we can take that same idea and expand it to the whole company. We weigh the factors that actually matter. And notice that huge 40% weighting on management capability. Why? Because people are everything in this business. A great team can make a decent project work, but a bad team will absolutely ruin a fantastic project. Sure, the geology and the execution plan are critical, but without a credible team to actually deliver, they're just pretty pictures in a PowerPoint deck.
You see, when you start using a framework like this, the whole power dynamic just shifts. Investors get a new edge, and the focus for the entire industry can finally move away from endless discovery and towards actual, tangible delivery. And think about who wins when we start demanding this kind of accountability. Well, investors get way better returns. The handful of legitimate developers out there find it easier to get the funding they deserve, and the industry as a whole starts to rebuild the trust it's lost. It's a win-win-win for everyone, except, of course, the guys running the lifestyle companies. All right, so how do you put this into practice right now? Here's your new checklist. Forget all the promotional fluff and just ask the hard questions. Number 1, and it's the most important, has the CEO ever actually built a mine? Does the company have a full feasibility study, a real engineering plan, not just some back-of-the-napkin estimate? Is their spending on salaries and admin under control? These are the questions that cut through the noise and separate the real builders from the pretenders.
And really, what this all comes down to is a massive, fundamental shift in how you should think about investing in this sector. For years and years, the big dream was to find the next giant discovery. But capital is just tired of chasing dreams. The next great fortunes in mining won't be built on discovery. They'll be built on delivery.
So that leaves us with one final crucial question for you. The next time you're looking at a junior miner with their exciting drill results and their really compelling story, just stop and ask yourself this one simple thing. Am I investing in a story, or am I investing in a credible plan to actually build something and deliver real value? The answer to that question will make all the difference.